Canada's retail sales bounce in August, but trouble looms ahead. For a brief moment in August, Canada's economy caught its breath. Shoppers returned to stores, sales climbed, and optimism flickered across the retail landscape. But as soon as September arrived, that flicker dimmed again, reminding policymakers that Canada's economic engine is still running on fragile fuel. A surprising summer uptick statistics. Canada's latest report showed that retail sales rose 1.0% in August, reaching $70.4 billion, a stronger result than most economists had expected. Even when auto sales were excluded, growth remained 0.7%, signaling that Canadians were spending more across multiple categories, from grocery stores to clothing outlets and fuel stations. This rebound was welcome news after months of sluggish consumer activity, driven by high inflation and rising interest rates. For retailers, it offered a brief sigh of relief. For policymakers, it provided a small signal that the worst of the consumer slowdown might be easing, at least temporarily. But September clouds are gathering. That optimism didn't last long. According to early estimates from Statistics Canada, retail sales are expected to decline by 0.7% in September. This anticipated retreat suggests that August growth may have been more of a short-term bounce than the start of a sustained recovery. Why the reversal? Several factors are at play. High interest rates continue to strain household budgets and borrowing power. Persistent inflation keeps prices elevated, leaving less disposable income for non-essential purchases. Rising housing costs and mortgage renewals are squeezing middle-income consumers. Consumer confidence remains fragile amid talk of a potential economic slowdown. The combination of these forces means Canadians are being cautious again, saving more and spending selectively. A tale of two economies. Canada's retail picture tells a broader story about its overall economy. Two parallel trends moving in opposite directions. On one side, employment remains strong, wages are slowly climbing, and certain sectors, like travel, food, and health, continue to perform well. On the other side, household debt is soaring, savings are being depleted, and credit card delinquencies are creeping upward. This split creates a difficult environment for the Bank of Canada. If consumer spending slows too much, growth could stall. But if the bank cuts interest rates too early, inflation could rebound, undoing months of monetary tightening. What the numbers really mean. Retail sales account for nearly 40% of total consumer spending in Canada, a major driver of economic activity. So, a one-month rise followed by a projected decline isn't just a retail story, it's a barometer of how healthy the broader economy is. The August boost likely came from back-to-school shopping, auto sales promotions, and temporary discounts. But September's expected decline indicates that these were seasonal sparks, not structural strength. The policy dilemma ahead. The Bank of Canada faces a delicate balancing act. Inflation, while lower than its 2022 peak, still sits above the bank's 2% target, making rate cuts politically and economically risky. Yet, slowing consumer demand, now reflected in weakening retail data, may soon force the central bank to reconsider its stance. If September's predicted decline materializes, economists may start calling for a rate pause or even gradual easing early next year. But any premature move could reignite inflationary pressures, particularly in housing and food. The bottom line: Canada's August retail surge was a welcome surprise, but it's not the start of a comeback story, at least not yet. The September forecast reminds everyone that the economy's pulse remains weak, and that consumers are still walking a tightrope between optimism and anxiety. The next few months will reveal whether this is just a temporary slowdown or the beginning of a deeper consumer retreat. Either way, one thing is clear: Canada's recovery is not guaranteed, and the real test for its economy lies not in how it rises after a good month, but how it endures when the momentum fades.